Welcome to this video, where we break down the basics of Forex trading in a simple, beginner-friendly way. Whether you've heard the term Forex floating around, or you're starting from scratch, this is the perfect place to begin. By the end of this video, you'll understand the key fundamentals, industry terms, and how trading currencies actually works. Let's dive in. So, what exactly is Forex? The word Forex is short for foreign exchange. It's the global marketplace where people trade national currencies. Unlike the stock market, which deals in shares of companies, the Forex market trades in money itself. It's where dollar share traded for euros, pounds for yen, and so on. Forex is the largest financial market in the world, with over $6 trillion traded every single day. Yes, you heard that right. Trillion with a T. And it runs 24 hours a day, 5 days a week, starting Sunday evening and closing Friday evening. So, where is the Forex market located? Well, here's the interesting part. It's not in any one place. The Forex market is decentralized. That means it doesn't have a physical exchange or central location. Instead, it's made up of a global network of banks, brokers, financial institutions, corporations, and individual traders, just like you and me, all trading currencies online. Now that we know what Forex is, let's talk about currency pairs. In Forex, you never trade a single currency. Instead, you trade currency pairs. That's because when you buy one currency, you're automatically selling another. For example, let's say you're looking at the currency pair GBP/USD. That's the British pound against the US dollar. The first currency in the pair is called the base currency, and the second is the quote currency. If the GBP/USD is quoted at 1.2500, that means 1 British pound is worth 1.25 US dollars. So, if you think the British pound is going to get stronger compared to the dollar, you'd buy the pair. That's called going long. If you think the pound will weaken, you'd sell the pair. That's called going short. Here are some of the most common currency abbreviations you'll see. USD is the US dollar. EUR is the euro. GBP is the British pound. JPY is the Japanese yen. AUD is the Australian dollar. CAD is the Canadian dollar. NZD is the New Zealand dollar. CHF is the Swiss franc. These codes are standardized across the world and make trading easier to understand. Now let's talk about the major currency pairs. These are the most heavily traded pairs, and all include the US dollar. For example, EUR per USD, USD/JPY, GBP per USD, USD/CHF, Australian dollar to US dollar, USD per CAD, New Zealand dollar per United States dollar. Why start with the majors? Because they're the most liquid. That means there are tons of buyers and sellers, so you can enter and exit trades quickly and with smaller transaction costs. Speaking of liquidity, liquidity refers to how easily a currency pair can be bought or sold without affecting its price too much. In a liquid market, transactions happen smoothly and quickly. The Forex market is known for being extremely liquid, especially the major pairs we just mentioned. Now, how are price changes measured in Forex? This is where the term PIP comes in. A PIP stands for percentage in point, or price interest point. It's the smallest standard unit by which a currency quote can move. For most currency pairs, 1 pip equals 0.0001. So, if the price of EUR USD goes from 1.1050 to 1.1051, that's a 1 pip increase. Some currency pairs, especially those involving the Japanese yen, are measured differently. For example, USD/JPY might be quoted at 130.55. Here, 1 pip is 0.01 instead of 0.0001. There's also something called a pipette, which is 1/10 of a pip. It's displayed as a fifth decimal place, like 1.10503. Some brokers show this for more precise pricing, Let's move on to another key concept: lot sizes. In Forex, trades are measured in lots. A standard lot is 100,000 units of the base currency. That's a big number, but don't worry. Brokers allow you to trade smaller sizes. Here's a breakdown. A standard lot equals 100,000 units. A mini lot equals 10,000 units. A micro lot equals 1,000 units. A nano lot equals 100 units. This lets traders with smaller accounts still participate in the market. You don't need thousands of dollars to get started. More on that soon. Now, let's talk about how brokers work. To access the Forex market as a retail trader, you need a broker. Think of a broker as your gateway to the market. They provide you with a trading platform and allow you to place trades. Most brokers also offer something called leverage. Leverage allows you to control a larger position with a smaller amount of your own money. It's expressed as a ratio, like 1 to 50 or 1 to 100. For example, if you have $100 in your account and your broker offers 1 to 100 leverage, you can trade up to $10,000 worth of currency. Sounds great, right? But here's the catch. Leverage is a double-edged sword. While it can amplify your profits, it can also magnify your losses. That's why risk management is key. Now let's get into two very important terms: bid and ask. Every Forex quote has two prices. The bid price is what buyers are willing to pay. The ask price is what sellers want in return. The difference between these two is called the spread. This is essentially the cost of the trade. In highly liquid pairs, the spread is usually small, which is great for traders. Here's a quick example. If EUR/JA/USD has a bid price of 1.1050 and an ask price of 1.1052, the spread is 2 pips. That's your transaction cost. Now let's take a look at market volatility. Volatility refers to how much the price of a currency pair moves over a certain period. High volatility means prices move fast and unpredictably. Low volatility means the market is calm and steady. Some traders love high volatility because it creates more opportunities for profit. Others prefer calmer markets for more predictable results. Either way, understanding volatility is crucial for timing your trades. So, what affects the Forex market? There are many factors, including interest rate changes by central banks, inflation and economic data releases, political events and elections, natural disasters or crises, trade agreements, and foreign policy decisions. All of these can influence currency values and cause prices to move quickly. Now let's explore how traders actually decide when to buy or sell. One popular method is called technical analysis. Technical analysis involves looking at past price data to identify patterns and trends. The idea is that history tends to repeat itself. By studying charts, traders try to predict future price movements. Here are a couple of simple examples. If a chart shows higher highs and higher lows, that's called an uptrend. Traders might look to go long, buying the pair. If the chart shows lower highs and lower lows, that's a downtrend. Traders might go short, selling the pair. Common tools in technical analysis include moving averages, support and resistance levels, trend lines, and indicators like RSI and MACD. Another method is fundamental analysis. This approach focuses on economic data and news. For example, if the U.S. Federal Reserve raises interest rates, the U.S. dollar might strengthen. Traders using fundamental analysis stay updated on global events and economic indicators. Many traders use a combination of both technical and fundamental analysis to make more informed decisions. Before we wrap up, let's recap. Forex stands for foreign exchange, the world's largest financial market. Currencies are traded in pairs, like Euro per USD or GBP per JPY. Prices are measured in pips, and trades are made in lot sizes. Brokers give you access to the market and often offer leverage. Bid and ask prices create the spread, which is the cost of the trade. Liquidity and volatility are key to understanding how the market moves, and trading strategies often rely on technical or fundamental analysis. If this helped you understand the Forex basics, be sure to subscribe and check out our free beginner's guide. It's the perfect next step to help you get started. Thanks for watching, and we'll see you in the next video.